Good morning, ARMR Insiders. Welcome to another session of the ARMR morning meeting. Get ourselves ready for the day trading session and for investing. Hope you all had a great long weekend. You're going to need that rest for the market we're dealing with this morning. So let's dive in. Of course, this is the ARMR investing way. This is how I run my own personal capital. Please do your own due diligence when you're putting money to work. Figure out your own risk tolerance. We follow the ARMR investing way. It's a three-stage process. All of our research goes on the whiteboard, not into our portfolio. We use algorithms to figure out when to move things from the whiteboard to the portfolio. Then we use stop losses to protect ourselves. So step one, the morning meeting, what's the information we're getting and how do we use the information? The information we've been getting since December 3rd is a risk monitor telling us it's red. Okay. For those of you who are new to the website, you can hop right in here and you can see the four tiles. When you click on ARMR Insiders, you get to our basic four tiles, right? The risk monitor's right here. You click on that, it'll tell you risk monitor's red. Whenever we change it, you can see the date when things have changed back and forth. So I write different things down for you. So the last time we wrote there was the 5th of January. But the risk monitor has been ostensibly red since December 3rd. Since then, if you look at the market, and what does red really mean? It tells us that at the very least, we have a confused market. Some indexes going lower, some indexes maybe going higher, no confluence. The basic and most important part of the risk monitor, and maybe a differentiator between what we do here at the ARMR report and what you see, maybe everywhere else, is that confluence is king for us when it comes to how the indexes trade. We follow the top 7 indexes. The S&P, the NASDAQ, the Dow, small caps. Those are the big ones. Then we have IBD 50, the innovative stocks, momentum stocks, and the value stocks. When we see all 7 moving in the same direction, what we're witnessing are the elephants on parade, the institutions. Our job is to get in front of the institutional movement. Right now, it's as if the elephants are all running in different directions. So when the risk monitor goes red, and it flipped for a second to yellow and then back to red, but ostensibly, it hasn't really moved since December 3rd. When it goes red like that, it's telling you that institutions are doing one of two things. They're either rotating capital from one sector to another, which creates a lot of volatility and no real movement in the indexes. So you've got to be careful because the elephants are stampeding in different directions. You're in the wrong names, you're going to get stomped on, which we're witnessing. Risk monitor red at its worst means we're going into a bear market. The market's going a lot lower, okay? So generally when we get this situation, it starts off with confusion. You're in the wrong names, you're getting stomped, other names are going up, which creates complacency. People think, well, there's just rotation, it'll be okay. Since December 3rd, the NASDAQ is down 2.33%, roughly. The IBD 50 is down 6.7%. Momentum index is down 5.5%. So since we went risk monitor red on the December 3rd, those are the worst indexes. The value index is up. The S&P is a little bit higher. Maybe probably by today it'll be around flat, maybe down a bit. The Dow, same thing, right around flat. So since the risk monitor went red, we've gotten no movement to the upside and some devastating moves to the downside in the leading innovative stocks, which leads me to my next point. So when we get risk monitor red, that can mean confusion. It can mean possibly rotation, but typically, if it stays red for this long, what it's really telling you is a top is being formed in the market. So that's the information. So last year we had a couple of red signals, and within maybe a week we went back to green. Okay, so red, things are confused, and then boom, all the elephants start stampeding in the same direction, pops to green, we start making money again. When we flip to red and we can't get to green since December 3rd, that tells you distribution. So the information is that the risk monitor can't get green for a couple of more than a month now, right? A month and a half now. And what that information tells you and how you use that information is that it's telling you a top is being formed. Now, I can tell you anecdotally, I've been doing this over 30 years, investing in a serious way, right? That's all I do. I commit all my time to. I've been doing it even longer than that because it's in my blood, it's in my family, right? So I'm a student of history. I can tell you, I've never seen a top form like this with this kind of destruction in leading innovative growth stocks not lead to a bear market. I've never seen it. If you'd like to argue with me and tell me how this time is different, I'm always open to other ideas. I'm willing to listen. I'm just telling you, I've never seen it. So at the ARMR report, we're making money in commodity stocks. We're up for the year, making money in commodity stocks. I'm not buying into the financial story, and we can see that that's been correct. JP Morgan's down big on earnings. Goldman Sachs not working. Okay. I don't believe that part of the story. But commodities, I believe. I think we're in probably the beginning of a commodity super cycle. Even commodity stocks will go down when the market gets ugly enough. So I'm not over my skis in commodities. I own some positions. I'm trying to manage my risk there. My stops have all been raised to break even. I'm not going to lose money in this market. No matter how much I love Deere and Caterpillar, they come back to where I bought them. I'm not going to just sit there and argue with the market and say they have to go up. Energy stocks start collapsing. I'm not going to argue with it and say, well, yeah, but energy should go up. Risk monitor red is the information. How do we use it? We raise our stops to break even. Now's the time to protect capital. We're going to capture upside later. There's going to be massive upside for us to capture at the ARMR report in the innovative growth stocks because our capital is intact while they're getting destroyed. And at some point, they're going to set up the most beautiful bottoms, you've ever seen. And we're going to get along that sector and we're going to make a fortune on it. Okay. But now's not the time to start guessing where the bottom is, catching falling knives. Now's not the time to do it. Now's the time to protect capital. So we've got energy plays that pay dividends in our portfolio. We have commodity plays that pay dividends in our portfolio. We own a handful of stocks that are not dividend oriented, but are, commodity related. Okay. And they're doing well for us. That's great. They're industrial related, right? But don't forget the rising wedge here. And this is going to be the key for us. Okay. First of all, this is the NASDAQ. So today's going to break it down, take out the lows of a couple of days ago, down to the 200-day moving average. But what I'm really watching, what I really care about, because if the selling gets bad enough and we get the bear market I'm expecting, this rising wedge in the Dow is going to break and it's going to get ugly. That breaking down will tell you that the industrial stocks are going to get attacked. So you can't hold on to Deere and Caterpillar that are in the Dow. We can't hold on to Magna or Ford or GM. They're going to get wrecked. These stocks are collecting capital now as institutions. The elephants are running in different directions, trying to figure out what to do, because the lion pack is coming, right? But eventually they're going to figure out we have to stampede out. That's what's going to happen. And everything goes down in that environment. So the risk monitor's red. We're in a negative gamma environment. We're gapping down this morning. There's nothing new to add to a portfolio. Now's not the time to be looking to buy something on a gap down in a negative gamma market where the risk monitor has been red ostensibly for almost 2 months. Now's the time to manage risk. So that's my thought for you from an investing point of view. Here's the trading posture that I'm going to have. So you have to divorce yourself. If you're going to be a good day trader, you cannot listen to a word of what I just said. You got to divorce yourself from the big picture. All we want to do is trade the indexes. When we have this much cash coming into the day and the market craters, we're looking to buy the weakness because the reward is significant. The risk will be mild because we're going to find the right entry point with a tight stop. And we want to trade those every time we see them during the day. And we might lose money on a couple of trades. It's okay. We're going to do it all week because at the end of the week, we'll have profits to show for our hard work. All right, I'm going to show you what I mean. Okay. This is the NASDAQ, this is the S&P on Friday. Big gap down. Market rallied up. Market sold off for over an hour. And so this is the trade that I want to capture every day. Every day it shows up. This is the trade I want to capture. I don't care about any other trades. I might take some other trades, but not if they get in the way of my ability to execute this trade I'm about to show you. This is hands down the highest probability trade with the least amount of risk. Everything else we do on the day trading desk carries higher risk than this trade. I'm going to show you what I mean, okay? It doesn't matter if the market gaps down or gaps up, or it doesn't make a difference. All we're looking for, in this case, it's a gap down, okay? But what we're looking for is a sell-off in the market that lasts for over an hour. In this case, it went from 10:30 to 1:30. So it was a lot more than an hour, which makes it only more compelling, okay? Because you're getting selling. We want sell-off for more than an hour that leads to a location. In this particular case, it was a double location. This purple dash is the spot gamma put wall, and this light blue line is the ARMR average true range low of the day. High probability locations for a reversal to occur. Then what we look for are three separate, different, three types of triggers. There's three types of triggers that show up that I'm going to trade every time I see it. There could be other triggers. Other things might work, but these three work over and over and over again. There is absolutely no excuse for not putting the trade on when we see these three triggers, because the probabilities are at their highest and the rewards are worth the risk. Not because I guarantee it makes money, but statistically speaking, if we trade them all the time and the statistics play out, we make money. Okay, here it is. This particular day, it's a 3-bar reversal. Comes down, touches the key location, up 1, 2, 3 bars in a row, those 3 blue lines. Okay, notice how on the selling, you can't get 3 blue lines in a row in the type of 3 blue lines that look like this, which, in candlestick charting is something close to 3 white soldiers, they call it. Okay, even on this rally here, you couldn't put 3 bars like that together. You see these 3 bars here, there was a lot of tails coming down, tails testing. Not the same. All the way down, you can't put 3 bars together like this. 1, 2, 3. Huge bodies, full bodies, higher. That tells you the cover is starting. Bang, bang, bang. That's one type of trigger. The other two, and I'll show you when we go to the live trading desk, I'll share this with everybody on the live trading desk with me, and we'll go look at the other 2 triggers. But suffice it for this conversation to say, the volume reversal trigger, which is a volume down bar after an hour of selling, we use 3-minute charts, so 3-minute bars, volume down bar that immediately reverses within 6 to 12 minutes. but actually 3 to 12 minutes. And the faster it reverses, the better. So when the big volume down bar and the price exceeds the high of the big volume down bar within 12 minutes, we get long. The stop on these trades is a new low on the day. It's not that far away to stop. It's a new low. And you can cut the position in half if you want, if it takes out the low of the bar we bought. And the third reversal trigger I use are median bar reversals. Comes right to the location, down bar, pretty big, kind of full-bodied bar. And the very next bar eclipses that bar. Like it's a full body up bar where they meet. They look almost identical. Boom, the market skyrockets. We're going to trade that every single day. I don't care what time of day it is. My best trades occur between 10 and 11:30. That's true. In a risk monitor green and yellow signal, that's really true. Risk monitor red, things get crazy. Volatility gets bigger. And so sometimes the time frame gets pushed later in the day because the selling's aggressive all morning. And then it gets tired. And the guys who own puts, if you want to understand why this trade works, the guys who own puts are making money all morning and having fun. And at some point they capitulate and they say, we've had enough. And they dump their puts. Dealers buy the puts, buy the underlying index, drive it higher the rest of the afternoon. That is a money trade. And we're going to be looking for that all day, every day on the ARMR day trading desk. I look forward to seeing you guys there with me. Any quick questions you've got? I got to go to set that up. Yeah, good point, Ares. I meant to actually bring that to everyone's attention. As I started this call, silver just popped 2%. So that's going to really help us out, right? Because in our portfolios, the ARMR portfolios, we have a healthy exposure to precious metals, which we increased our gold and silver position, I think it was early last week, in the bullion. Okay. Now, I have room to increase my exposure once again. See, there's 3-bar reversal right there in silver, and this is going to pop it out above the 50-day moving average. So I have room to increase my silver silver stock position, SILJ. Okay. If it can close above the 50, I'll increase that position. But I will submit to you that if the selling gets ugly enough in the market, silver stocks, gold stocks, they're just stocks in a portfolio. And so if the selling is ugly this morning and gets uglier, eventually you get to that point where stocks are just sold. I'm holding the bullion, Sprott physical gold, Sprott physical silver. That I'll hold on to. But I'm trying to manage my position size in the stocks, and I don't want to get too aggressive. And God knows I'm not going to get real aggressive first thing in the morning on a gap up in metals. Okay, let's just be clear on that. But we already have our position on. We could add to it today if it closes right. But we really have to see how the market behaves. Quick note, it's OPEX week. So theoretically, the market should gravitate to the largest strike, which is up around 4,700 on the S&P. So we're opening down, I don't know, maybe below 4,600. I don't know where we're going to open. But so between now and Friday, if it's a normal market and not one that's really turning into a bear market, the market should trade around the mean this week. So gap downs should lead to great buying opportunities for bounces to trade. The big picture, risk monitor red, negative gamma, Fed reducing liquidity, rising interest rates, all of these types of things, that's negative. But in a short-term vacuum of a week of OPEX, you could easily get big selling and then that rip higher like we saw on Friday afternoon. So we're looking for that trade. It may not develop if we're in a real bear market. That will tell us something. If that trade doesn't work, then we really know that the 2-month consolidation in the market is really a top, and it's going to get ugly because that trade that worked for 2 years will start to not work. Okay, but statistically speaking, In an OPEX week, you expect mean reversion. And from what we're reading out of spot gamma, it's not like there's a huge amount of puts being bought all of a sudden that's rolling put walls and call walls lower. That's not really happening. So unless that develops, we can expect mean reversion higher after big gap downs. So yeah, silver and gold look great, and they should look great, right? We should get paid on these things. We'll see if it happens. We'll see. All right. I look forward to seeing you all on the live trading desk. Get around somewhere around 9:15. We'll get that started. We'll set up our spot gamma locations on all the indexes. And of course, I'll be sharing as much information as I can on the Slack trading desk all day with you guys. So stay nimble, be patient, protect capital. Those are my thoughts for you this morning. Take care, everybody.